Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The new tariffs between the U.S. and China have now been implemented as of July 6th, and the markets continue to find weakness in the midst of the bantering back and forth. As we can see on the corn contract, we have a pattern now over the month of June and July that appears to be a continuation pattern. And if this market is not able to find some form of support near the 345 area, we are concerned now that the market could very well give us a pattern of decline that matches the continuation pattern on the other side. That suggests that September corn could very well reach somewhere in the neighborhood of 310 to 320 in the event of a continued decline going forward. The supply and demand report from Thursday appeared to give us a bit of hope with the market looking to have an outside reversal strength, but all of those gains have since been surrendered and the market continues to move downward. We're now sitting at 3 standard deviations below the point of control, somewhere in the neighborhood of 375, and the market continues to find potential weakness, closing at the lows of the week. An area of support in particular for the September contract that we would have liked to have seen find support would have been the 342 3/4 number. The market closed twice below this number this week, and as we can see, we'll probably finish below that level. This 360-degree mark oftentimes can be a capitulation support or resistance level depending on the direction upon which the market reaches. Now that we are finding ourselves closing below this level, the next potential support level that we're looking at is at about 324.5. This 90-degree mark also happens to coincide with volatility-based support, but we anticipate that an alternative volatility-based support band near the 330 number could very well set in as well. So for now, we're looking for the market at the very least to potentially make a move down in the neighborhood of 325 to 330. D's corn is giving us much of the same, and we can see a similar continuation pattern that has formed. In the event that this market now breaks below the 350 number, we are concerned that we can see a decline similar to the move that made its way into the continuation pattern materializing on the other side. That suggests for us then that December corn could find itself somewhere in the neighborhood of about 330. Volatility-based support for the December contract comes in very close at 338. And so we're looking for somewhere between 338 to 345 to potentially be the area where we find potential support for this near-term decline. If this market's able to bounce near this volatility-based support band down below, this is the area from which we anticipate a potential bounce could occur for the December contract. September beans has also tested its 360-degree mark at 820. And if this market's not able to find support at this 820 number, we believe that the next downside support level may not be until the market gets to about 791.5. Volatility-based support down below is near the 180-degree mark of 763 3/4, but we can also see that our volatility bands are starting to make a shift to the upside, and so perhaps somewhere in the neighborhood of 790 to 800 could finally be where this market finds a bit of support. Alternatively, we do have our key support band coming in at the 800 mark. And so again, coming in for this market here, it may not be for another 25 to 30 cents before we can find reasonable support coming in for September beans. November beans is giving us much of the same. We would also like to highlight the strength upon which we can see the downside momentum coming in for this contract as well. From here, we can see that previously we had some momentum strength to the upside and marginal weakness coming in, but this most recent downdraft suggests that beans does have further to go to the downside if it's not able to recover and make its way back up to what we call the zero line. Upon reaching the zero line, we would like to see some upside momentum finally develop, but from here, the market is currently finding potential support sitting right at about the 830 mark. But below this 830 number, we think that another downside leg could very well be in play, with the minimum price objective perhaps coming in close to $8. From this perspective, we can see that the 360-degree mark comes in at 816 for November beans. And the fact that the market is looking to finish the week out near the lows of the week suggests for us that touching 816 is probably a high probability matter. We do have our bands finally starting to move to the upside, giving us some hope of potential support again near this 360-degree mark. But upon breaking that 816 number, we would look for potential support to set in somewhere in the neighborhood of 788. September wheat was not able to make its way past resistance near the 515 mark, and from here the market did decline after having been dragged down by soybean and corn. We finally got a true marginal break of the previous lows that we had talked about before, with the market coming in and breaking just below the 360-degree mark, and over the last couple trading days it finds itself moving up marginally. From here, since we are at our time factor that we'd been looking for, we anticipate that we could very well continue in a sideways movement for the rest of July and probably going into August before we can see a trend start to materialize in either direction. The US dollar continues to give us much of what we've been looking for, with resistance coming in near the 95 mark and support at the 93.5 number. In fact, the market found a bit of stepped up support right at the 180-degree mark at 93.88. So from here, as long as the market continues to stay range bound at these levels, we don't anticipate any real large movement coming in. We do have our volatility bands starting to narrow, and once these bands completely narrow, this is the point at which the market would then look to make a breakout on either side and to give us a nice new trend in either direction. Taking a look at the longer term weekly chart shows us that the market is doing as would be expected, giving us 6 to 8 weeks of consolidation after having reached inside of volatility-based resistance. Once this market completes its 6 to 8 weeks or 6 to 8 bars, since this is a weekly chart, the market would then look to break out on either direction. A corrective move that comes in about midway between volatility-based resistance and volatility-based support could be reasonable. On the flip side, if the market is alternatively able to break above the volatility-based resistance band, we would then be looking for the next leg to the upside where the market could potentially make a strong rally upside. So over the next 2 to 3 weeks, we would like to see the market continue sideways, and then from there give us an indication as to which direction it may want to go short term. Thank you for joining us for our regular market update. Look forward to touching base with you again next week.